I heard you all had a I heard you all had an excellent presentation last week, courtesy of Pastor. And hopefully this week I will do justice and it will be valuable for everybody that's listening. So just to be before we begin, sorry, just to start with a disclaimer that nothing that is presented this evening should be taken as personalized financial advice. It is financial education and general information. So we've had the introductions. That's myself. That's Pastor Endabelli. And as he said before, just looking at the agenda for tonight, we're looking at why savings matter, emergency funds, understanding debt, good debt versus bad debt. You might be thinking, is there such a thing as good debt and bad debt? Well, we'll explore that later. Debt reduction strategies, and then there will be an opportunity for you to ask some questions. And hopefully, you've got lots of questions for us this evening. So, if we have a look at the UK, and this is from the FCA's Financial Lives Survey in 2024, we can see that only 10% of adults have no cash savings whatsoever. I can't imagine not having anything saved, but that's the plight of at least 10% of the UK population. A further 21% have less than £1,000 in savings. 42% cannot cover their expenses for more than 3 months if their income stops. And 24% of adults, that's 13.1 million adults, are deemed to have low financial resilience. What that means is if something happens, there's a death in the family, so they have to pay for a funeral, there's no way for them to bounce back easily. So that's what we call low financial resilience. And when you look at these statistics and you look at what can happen when things go wrong or the unexpected happens, then saving is not optional. It is really essential if you want to be financially stable. We look at the Bible, I mean, God was the first financial advisor and still is the best financial advisor. And if you read the book of Proverbs, there are many, many wise quotes in that book. And I absolutely love Proverbs and Ecclesiastes. But we can see here in Proverbs 21, verse 20, it tells us the wise have wealth and luxury, but fools spend whatever they get. Now, we do see people in this world that have an abundance of wealth, and not all of them have accumulated their wealth in an honest way. So, we're not really talking about those types of people. What we're talking about the hard-working people, the people who save, who are wise in how they spend, they will have wealth and luxury. Now, wealth and luxury, again, very subjective. It's all dependent on your own definition. But I think if you've got food on the table, roof over your head, clothes to wear, you can afford to go on a holiday, run a car. For me, that's classed as wealthy. When you look at the majority of the population of this planet that probably live on less than $1 a day, less than $5 a day, then you can safely say that anyone that can achieve what I've just mentioned are definitely in the top 5% on this planet. So saving is wisdom. Scripture frames saving not as deprivation, but as evidence of wisdom and foresight. And as we can see, spending everything you earn, which some people do, that's why they've got credit card debt or other unsecured debts, spending all income without reserve creates vulnerability and financial fragility. And at the end of the day, is foolishness. I'm sure you'd agree with that, wouldn't you, Pastor?
Mhm.
Yeah,
Yes.
yeah. So, emergency funds, then, why they matter. 13% of people are heavily burdened by bills and credit commitments. Sometimes it's not necessarily because they've been overly lavish, it's just the circumstances that they find themselves in. But if you can save and have at least, £1,000, it's going to help when times get hard. You might lose a job and it takes a while to find another one. 8% of people are in financial difficulty, as I said, and have missed more than 3 months' worth of payments in a 6 month period. And 9% could not cover even 1 week of expenses if their income stopped. So you can see that a lot of people seem to be living hand to mouth, which I'm sure you'll all agree is not a great position to be in. So having some form of emergency funds prevents those small shocks from becoming crises. And it really does matter in times of uncertainty like the ones that we're living in now. If you turn on the news, obviously you can see there's a lot being said about the US-Iran war, oil price inflation, which eventually will lead to food price inflation. Now, food for most people is a basic commodity, but if we do see hyperinflation in the second half of this year, food might be a necessity for most people and not the luxury that it can be from time to time when you pick up the extra bits in your shopping. You're going to be looking at the basics as the essentials and not the other things that we might put in the basket, like, I don't know, biscuits, crisps, all the other things that we might enjoy eating if the food price inflation is as bad as predicted. So, emergency funds, in terms of looking at your starter fund, if you can, and I know it's not easy for everybody, but if you can, you should start with at least aiming for 500 to £1,000 worth of emergency funds. And that's your first goal. And that will cover surprise bills, car repairs, if you can afford to run a car, or even small emergencies. It's a start. Secondly, you'd want to build what you call a stability fund, and that's 1 to 3 months worth of expenses. Now, we say expenses rather than income because you might be in a privileged position where you only spend half of what you earn. So, really, what we're looking to do is cover those essential expenses that you have to meet, such as rent, mortgages, utility bills, council tax bills, those types of things, rather than the discretionary expenses, which might be clothing or going out for a meal, buying a takeaway. It's the essential expenses that you're looking to cover with your stability fund. And that will give you short term peace of mind should you lose a job and it takes 3 months to find another one. Realistically, in this day and age, it's probably taking up to 6 months to find a new job if you are unfortunate, depending on the type of work that you do. And then step three, once you've got your stability fund, you're going to look to build your full emergency fund, which is 3 to 6 months worth of expenses. And I would suggest it should be at least 6 months worth of expenses. If you can go to 12 months, even better. But like I say, if you are faced with situations where interest rates have increased significantly and you've got things like mortgage debt and inflation has crept in. I mean, fuel prices now are just ridiculous. I drive a diesel car, and probably 3 months ago, it would have costed me about £65 to £70 to fill the tank. Recently, it's been costing me £115 to fill the
Ooh.
tank. Yeah. So
Mm.
that's almost double just on fuel. Fortunately, I work from home and only have to go into the office once a month, but my office is in the Midlands in Birmingham and I live in Manchester. So I'm grateful and thankful that I don't have to be in the office more often than that because that's not something that I can claim expenses for, my travel costs. But depending on the type of work you do, some people that might be an additional burden to have to travel quite far in a week if fuel prices have increased and you happen to drive a car that has got the highest pricing at the pump, which is diesel. So these are things that can happen overnight. I mean, this is just since what, 28th of February with the US-Iran war. So you really need to be thinking about having an emergency fund that stretches beyond 6 months, I would say 12 months. But this is the standard advice that advisors do give to people when it comes to building your emergency fund. So build gradually. You might think, well, I don't have much, but even £20 a month is a start. And I know in the past, when I was growing up, my mother used to do what's called a partner. And a lot of people here might not know what that is, but if you're from a Caribbean background, it was a way of saving a small amount of money each week. And then once you built up a certain amount, you could then get what they call is a draw. But however you look to save your money, whether in a bank or credit union or whatever it is, just start saving and start small. And eventually you'll be surprised how big things will grow. So when it
Before
comes,
you move on,
yes,
just to add, the assumption is that you know your expenses. You know
Correct.
how much you will need to cover your bills over 3 months or six
Yeah,
months, which
absolutely.
is one of the reasons or the fundamentals we covered last week at looking your income and looking at your expenses.
Yeah,
And if you don't know that basic information, you're already struggling here because you don't know how much you need to cover in 1 to 3 months. So it's going back to that detail and knowing
hmm,
exactly and taking account of how your expenses uh, come and where they are from and how much they add up to in a month. And then you can know how much 3 months worth of savings, 6 months worth of savings. And, sometimes we just look at the big ticket items like your rent or your mortgage and whatever, but there's a lot of other money that might even exceed those big ticket items. Um, they just go unnoticed. So it's
absolutely.
essential to take full note.
Yeah.
Thank you.
No, and I think that's a great point that you've made is to go into detail with your expenses. You should know by line how much you spend on various bills, activities. What you need to do is split your expenses between your essential expenses, the things that if you don't pay, they'll take it away, and that includes your house, and the things that are discretionary, nice to have, but not need to have. And if you can split it between the two, then what we're talking about is covering those essential expenses that you've got to pay. You have no choice in that. If you don't, you're going to get yourself into a lot of trouble legally and financially. So, as Pastor said, we really need to get down to the finer details of our budgeting and understand where we spend our money and how much we spend. So, we're going to look at debt management and credit health. And this is really about taking control of your financial future. We'll give you a practical guide to understanding debt, protecting your credit health, and building lasting financial resilience, the ability to bounce back when life throws a curveball. So, from a biblical perspective on debt, we know again in that wise book written by the wisest man that ever lived, King Solomon, he reminds us that the borrower is slave to the lender. Debt creates obligations, and every debt payment is a portion of your income that's already committed. So it reduces your freedom to choose. You have to make those payments. So that's money that's already committed, and therefore you can't do anything alternative to paying off that debt. God desires us to have freedom. Scripture consistently points towards financial freedom, the ability to choose, having choice, and the ability to give and bless others and live without financial bondage. And I think that's a very important point that, God doesn't expect us just to spend everything that we earn on ourselves. He also expects us to be generous to others. And it starts with being generous to God, giving what belongs to God, our tithes, and then giving what we would like to be generous with towards God. That's our offerings to say, thank you, Lord, for the things that you've blessed me with. And then also remembering to bless others as well who are less fortunate than ourselves. And if you're the type of person that can live within your means, live without debt, you're going to have the ability to help others at the same time. So we've got a UK snapshot here of debt in the UK. And as we've said before, we can see the figures here. 84% of adults hold at least one credit or loan product. 19% revolve a credit card balance month to month. That means you'll take out a credit card, maybe it's a 0% interest credit card, and you'll use that to pay an existing credit card. Then, when the 12-month period is over, you might try to find another deal and you just keep revolving the debt. Rather than paying it, you're just moving it around. And 5%, that's 2.8 million adults, have persistent credit card debt. They're paying the minimum, it just won't go away. And 8% are constantly or usually overdrawn. Again, these are positions that it's not healthy to be in at all. It's not healthy mentally, it's not healthy financially. And when it comes to debt, whilst it is widespread, you need to manage it. If you've already gone too far and you find yourself in one of these categories, then there are plans that you can take out in order to manage those debts. But as it's always said, prevention is better than cure. So if you can stop yourself from accumulating unnecessary debt, you won't have to then try and find solutions to work out those debts in order to survive. Pastor, is there anything that you'd like to add to that?
No, no, go ahead.
No? Okay. So the UK debt landscape then, the average total debt per adult back in May 2025 was just over 35,000, and that does include mortgage debt. 4.1 million UK adults have what we call problem debt, i.e., it's not going down, you're paying it, but it's just not going anywhere. The interest adds to it, and before you know what, this debt is hardcore debt. 48% of adults are holding ongoing credit or loans, and the average unsecured debt, that's not your mortgage debt, but this is credit cards, store cards, every other type of card apart from one that's backed by property, on average is about £15,672. That was in 2024. I can assure you that figure now is probably closer to about £20,000 an average unsecured debt. So individual insolvencies in England and Wales reached their highest level since 2010 in 2025, and it feels as though that will continue into 2026. So, credit health and financial resilience. Again, going back to the 2024 survey, the FCA survey, 24% of all UK adults have low financial resilience, as we mentioned before. 49% of adults show at least one characteristic of vulnerability, which means, if they were to lose their job, it's going to be very hard for them to make ends meet, but they may have a small level of emergency funds saved that will keep them going for a month or two, but then after that, they're probably going to be in significant trouble. 7.4 million of adults felt heavily burdened by bills and credit commitments. So you can imagine how that will play on your mental health. And 1 in 10 people have no cash savings whatsoever. Now, it's interesting to note at the bottom of the slide that renters are more than twice as likely as mortgage holders to report not coping financially. 50% of renters versus 24% of mortgage holders. And of the 1.7 million adults who used a debt advice service, 61% said their debts were more manageable as a result, which it shows that seeking help works. As they say, never suffer in silence. There is help, but sometimes it's the embarrassment factor why people don't want to go and seek advice. But if you find yourself in any of these situations, the best thing to do is to go and seek advice. If you've tried to manage it for a long time on your own and you're not getting anywhere, then you must go and speak to a debt counsellor and you can get the help that you're looking for. So we're looking at good debt and bad debt, and there is such a thing. So things that are classed as good debt and probably unavoidable debt is things like a mortgage. There's very few people that can buy a house cash, especially in this day and age where property prices have risen significantly. Education, there are some degree courses that it might be worth getting into debt for. Obviously, if you've got the opportunity to go in an apprenticeship and get to the same level as doing a degree, that might be a better alternative, sorry. But there are some careers or vocations where you do have to go to university. I'm thinking of medical professions, that type of thing, where you do have to go to university. So that would be good debt. And then there's business investment debt, where you borrow money to invest in a business, and over time, that business will generate a return that will then help to pay back the debt and obviously produce an income for yourself. So, those types of debts are good debts, especially if managed properly. And especially when it comes to business debt and a mortgage, I would never go to the very top of what you can afford to. If the multiples are up to 6 times your earnings, you might want to keep your debt at 4 times or 5 times, but never go to the absolute peak because, again, you put yourself at risk that if you were to lose a job or lose your main income stream, you might be faced with a situation where you can't afford to meet those debt repayments. Then there's bad debt. So obviously that's high interest credit cards. They compound and they just continue to grow. Credit cards in and of themselves are not bad. And if you want to develop a good credit score, then you need to have a credit card. But what you can do is use it for convenience, pay it off every month. So therefore, you're not developing any hard debt. It's just for convenience. And that's what I do. I use my cards to go shopping. It's easier than having cash. But at the end of the month, everything gets repaid. Then there are payday loans. These are extremely high average percentage rates, and the debt can spiral out of control if you're not careful. There's buy now, pay later traps. People tend to use those if they've just moved into a new property, whether renting or purchased, and they'll buy on credit, looking to pay later down the line. Circumstances change, and that debt becomes another trap. And then there's lifestyle debt, borrowing for consumption, not investment, trying to live a lifestyle to portray a certain image, just to get, I don't know, um, applause from people. Fake it till you make it, sometimes they say, but that's not a good thing to do. If you're borrowing for consumption, then anything you purchase is basically worth nil after you purchase it, whether you go for meals all the time or you buy clothing. Think about it when you purchase an item of clothing or a pair of shoes. Once you've worn it, it has no value. But if you are borrowing for investment, there's a potential that that investment could increase in value, and therefore you could use that to repay the debt. So that's just the difference between good and bad debt. Any comments from yourself, Pastor?
Yes,
Yeah.
so my wake up or my awakening came by understanding the distinction. And so we'll talk a little bit maybe later in future sessions. When I started investing in real estate, for example, I gained that clarity between what was good debt and what was bad debt.
Mm-hmm.
And so good debt is one that grows assets for you and has the potential for generating income streams for you. And bad debt is the one that takes money from your pocket and you never see anything back in return.
Yeah.
And if you just have that image in your mind, one goes out and there's a potential for something coming back into your pocket.
Mm-hmm.
And the other one is just continually taking from your pocket and you never see anything coming back. That's bad
Absolutely.
debt.
Yeah.
Yeah.
Yeah. And like you say, with good debt, there's always some equity in it for you, be it a property or a business that's going to, produce profits, or even education. You leave university, you get a job, and that job pays you an income that will continue to grow during your career and allows you to pay back the student loans. And that's something we can look at on another week, in terms of student loans. Should you repay it? Should you not? We can provide answers for that on a later um, evening when we do one of these presentations. So, warning signs of you having a debt problem: when you can only make the minimum payment on a credit card each month, that's a red flag that you have a debt problem. When you don't know the total of all your debts or the interest rates that you're paying, you're burying your head in the sand, trying not to look, that doesn't help. Using one credit card to pay off another, I've mentioned that before, and being regularly overdrawn or unsure what your bank balance will be. Other red flags include receiving past due notices or ignoring mail from creditors. Now, this is getting into the area of probably becoming mentally ill from having debts, depression, that kind of thing, because it's just not going away. Borrowing money on behalf of others. If you've got a sister or a brother and they're in a debt situation asking you to borrow money for them, that's not great. I would avoid that, but obviously that's a personal decision. Impulse buying or using spending as emotional relief. Never a good thing. because that's just temporary. When you get back home and the bills come back in, you're back to square one. And then feeling overwhelmed, anxious, or humiliated about money, that's also not a good sign. And that's a red flag that you've probably got a debt problem, and probably you also need to speak to someone that can assist you and help you in terms of managing the debt. Let's go on to the next slide. So, the hidden cost of minimum payments. So, if you have credit card debt, but you can only make the minimum credit card payments, then the reality check is that if you have an interest rate, which on average is about 24.65% per annum, and your credit card balance is around £1,900, the annual interest cost simply on that debt will be about £468 a year, which is 25% of the outstanding balance. And it would take you, with minimum payments only, over 7 years to repay that debt, which is just ludicrous for such a small amount. The total repaid is nearly double the original balance. So instead of owing £1,900 and paying back £1,900, you'd be looking at paying back about 3,800, probably closer to £4,000. And credit card debt outstanding in the UK in the March 2025 was about 73.2 billion. So that shows how many people in the UK are using credit cards to fund their lifestyle. Can't tell you whether it's essential items that they're spending it on, or just discretionary items, going out for a meal, going out at the weekend, entertainment, holidays, etc. But that's the state of the UK in 2025. So, mortgage arrears alert. Average mortgage arrears per client in 2024 was £10,229. That was up 69% from 2023. And I can guarantee you that would have been even higher in 2025 and probably increasing in 2026. If you've had the opportunity to fix your mortgage rate, that would have been a good thing to do, even though we don't know where interest rates are going to go. But I think looking forward and the forecast for stagflation, we're likely to see interest rates to go up further. So high interest rates since 2022 continue to ripple through household budgets, and even employed households are not immune. 57% of UK adults are in problem debt and in full-time work. So just because you're in full-time work doesn't mean that you're immune from this, as we've seen where there are people, both people working with a mortgage, they can still have this issue where they've borrowed to the absolute maximum that they could. And it just takes a few percentage points increase in interest rates and they're already having problems. So that's something you want to avoid if possible. So I was talking before about essential and non-essential spending. Now we're looking at priority versus non-priority debt. And you've always got to pay your priority debts first, because that's the one that will get you into the most trouble if you don't pay it. So rent or mortgage payments, what will happen? You'll lose the roof over your head. Council tax, they can take you to court. Income tax, national insurance, VAT, you know, if you don't pay them on time, they'll add interest. So that debt will continue to increase if you're not able to make those payments. Gas and electricity bills, well, we all know what happens. They'll just simply switch off those utilities. And there's not many people that can afford to live without gas and electricity, especially in the winter in the UK. TV license, well, you could argue you could do without that. So if they did cut that off, that's probably a good thing, actually. Court fines and child maintenance, you don't want to miss payments on those. And hire purchase on essential items, again, you don't want to miss payments on that. It could be a car that you've got HP on or some other item. But again, if you don't pay, they'll take it away. So these are the priority items. And in looking at your essential and non-essential expenses, where you do have debt, you need to prioritise those between priority and non-priority debt. Now, the non-priority debts, credit card and store card debt, you can choose, how much to pay and when to pay. All that will happen, as we've said before, is that high APR will continue to add to whatever you've got outstanding on your card. Personal and payday loans, they're extremely high interest rates. So again, that will just get you into more debt if you can't pay, but at least it's a little bit discretionary compared to the priority ones. Overdrafts, similar. Money owed to friends or family. I think that's the one that suffers most. You know, people tend not to pay family back if they're in problem debt. But then you probably don't want to see those people either because every time you see them, you're thinking, oh no, I owe money. I can't look them in the face. And so that becomes an embarrassment. Then you've got catalogue or in-store credit, and you've got buy now, pay later balances. So these are all the non-priority debts, but still very important for you to be able to manage and repay. And in Romans 13, verse 8, it says, let no debt remain outstanding except the continuing debt to love one another. So I'm always amazed when people owe money, but yet you still see them going on holiday, or you still see them going out to eat, or doing things that people who don't have debt are able to do. So if you're in debt, you should make that a priority. Ellen White says, owe no man anything. And the Bible says that as well. And she said, even if you have to live on, porridge, or I would say beans on toast. You might just need to adjust your lifestyle in order for you to be able to service those debts. But you should service them. It is your duty to live an honest and upright life. So again, it's about managing your appetite for spending and knowing when to say no to yourself and when to say, you might treat yourself or buy someone a birthday gift, a Christmas gift, etc. But look at the debts and see what type of things are you getting in debt for and is it worth it? Ask yourself, is it worth it?
And I think the key thing here is that debt robs you of the money that you need for investment.
Yeah,
And so it will be pointless for us to cover investing and creating a generational wealth if all your money is being taken up. These business companies, I remember the chief executive of Barclays when they introduced the Barclay cards. He actually said he will not allow his family to have a credit card because that's a fool's way of thinking that you are in control.
yeah,
And he was the CEO of Barclays when they launched the credit card.
mm,
So by managing debt, we are actually releasing funds that we can then look into investing to create future wealth or to
correct.
build assets that can supplement our income. So it's absolutely essential.
Absolutely. And as I mentioned before, you might want to use a credit card just for convenience, but not to have hardcore borrowing on. It's just for convenience. So you have to be very disciplined that whatever you use to spend your money on with a credit card, that you do pay it back at the end of the month before the statement comes through or after the statement comes through to ensure that you're not incurring interest and that debt's not remaining hard debt on the credit card. So we'll look at some debt reduction strategies. What can you do if you do have debt? And there are many different strategies that you can employ. One of them is the snowball method, where you pay the smallest balance first, and each paid off debt builds momentum to keep you going. It's just to boost your confidence to say, well, I'm getting rid of this debt. You start with the smallest one first. But there's also the avalanche method, where you might start with the highest interest rate first because that's the one that's stinging you the most. So if you do have store cards or credit cards with large balances on there, you might want to pay them off first simply because the interest that's accumulating is much higher than maybe some of the smaller balances that you may have, like an overdraft, let's say. And then there's consolidation. So you're looking at multiple different pots of debt and you're consolidating them into one lower rate product. It could be your mortgage. You might want to re-mortgage your property and just put those debts that you've got that you've been trying to pay off for the last few years and you just can't get rid of them, put them on your mortgage because your mortgage interest rate is significantly lower. You know, it might be 5, 6, 7% versus 25% on a credit card. So it would make sense to consolidate those debts, put them on your mortgage, but then don't get yourself into that kind of problem again. It's not about clearing the credit card or the store card and then starting to use them again and build up debt. Once you've done that, cut them up if you need to, but discipline yourself and start to live within your means. And where you do have surplus income, start to save towards the emergency funds that we've talked about earlier. You can negotiate the rates that you pay. You can call the lender and ask for a lower interest rate. And it's surprising that they are open to it. They'd rather you pay back the debt than default and they have to write it off. So if you find yourself in that situation, you know, pick up the phone, phone the lender and see what you can negotiate with them. And the main thing is to stop new debt. So while you're reducing existing debt, or if you've managed to consolidate it onto your mortgage, so you've cleared all these credit cards, store cards, do not get yourself into that same situation again. And definitely don't use credit card debt or overdrafts to go on a holiday. You know, a holiday is not essential. So start being disciplined with yourself and learning to say no to certain situations. And even, you know, opportunities to go on holiday with friends, family. If you can't afford it, you just have to say, I can't afford it. But it's better than getting into debt and then having to pay that off for the next 3 to 5 years. So 6 debt eradication options that you've got. The first one is a debt repayment plan, and you can manage that yourself. As we've said, you prioritize your debts, look at the smallest ones or the largest APR, whatever it is, and you can go through that debt repayment plan and negotiate with the debt providers to get a lower interest rate. But that's something that you manage yourself. Okay. The second one is a debt management plan, and that's where you'd use a licensed advisor and they will negotiate with the lender on your behalf. And then what they can do as well is to consolidate all of those payments into one monthly payment. So you'll pay them, and that monthly payment they'll use then to pay all the individual lenders that you've accumulated debt with. Then there's debt consolidation, which I've talked about, which is like a new loan or a mortgage extension to repay all of your existing debt. It reduces the monthly outgoings, but it may extend the term of the mortgage on your property and reduce the amount of equity depending on how much you've got in debts to add to the mortgage for that one. Then you've got an individual voluntary arrangement, an IVA, you've probably heard it called, and that's a legally binding agreement with your creditors to accept less than is owed. It's normally repaid over 5 years, helps to avoid bankruptcy, but you will need to get a debt advisor stroke insolvency practitioner involved. So there's a fee involved with that one, but it will help to alleviate the debt burden. Then there's a debt relief order, and that is for debts under £50,000 where you have minimal assets, i.e. less than £2,000 worth of assets, and you have less than £75 per month in spare income. It's free to apply for. The debt is frozen for 12 months and then it's written off if your situation hasn't improved. But the downside to it is that it does stay on your credit report for 6 years, which means that you're going to find it very difficult to get credit, be it a loan, store card, an overdraft, whatever. Because that sits on your credit rating for 6 years, it will make it difficult to raise new debt. And then the last resort will be a bankruptcy. And that's where you will go to court, an official receiver takes control of your assets, and that is typically discharged after 12 months, but it does have an even longer term impact than the debt relief order. So hopefully no one on this webinar this evening is in that situation where they would need to go through a bankruptcy court order. But if you do, take steps, or if you feel you might be at that point, take steps as early as possible to see whether you might be able to do a debt relief order instead. But the sooner you sort it out, you know, the easier it will be all round. So these are some of the options that you can use. When we're looking at debt and we're looking at emergency funds, we're looking at protection as well. So if you've got a mortgage, it would be wise to have some kind of life assurance linked to that mortgage. So if one or of the main wage earners, or if it's a double income household, but it requires both wage earners to pay the mortgage, having a life insurance policy against that mortgage means that if one of you dies, the mortgage will be repaid. So the family can continue to live in the property without the wife or the husband having to move out with the children to find somewhere else to live because they just can't meet those mortgage payments. It can include terminal illness benefit. So if one of you is diagnosed with a terminal illness like cancer, then it can pay out whilst you're still alive, but you would need to get confirmation from a doctor that you do have a terminal illness and you've probably got less than 12 months to live. The second protection that you might want to look at is income protection. Sometimes, both life insurance and income protection will be a benefit with your employer as part of your employment. But of course, the life insurance will be there to cover funeral expenses and other items. It's not necessarily going to be enough to cover your mortgage. So you will have to have separate mortgage protection. But income protection, that can pay an income up till state pension age if you find that you are unable to work for the long term. There is a payment deferral period normally linked to if you have employment, then you'll normally have some type of sick pay arrangement where it might be 6 months full pay, 6 months half pay, or 3 months full pay, 3 months half pay. But the income protection would kick in when you get to the period where it's half pay or no pay. It is limited to up to 65% of your earnings. And the good thing about that is insurers cannot cancel while the premiums are being paid, so you have control there. Critical illness cover, I sort of mentioned it with the life assurance, but you can have cover that's life and critical illness cover, or you can have separate critical illness cover. But again, it's there if you are diagnosed with a terminal illness or a critical illness, and it can pay out a tax-free lump sum. And you can use that to either pay off the mortgage, amend your property. If you can't go upstairs anymore, you have to stay downstairs. You could use that to make some of the adjustments that might be needed. But that would be something that you could consider. And income replacement, that's the short term equivalent of income protection. Income protection pays you until state pension age. Income replacement will pay you for 12 to 24 months. So it's a short term gap. That would give you enough time to get better because normally it's due to sickness or unemployment. And during that time, obviously you'll be able to rehabilitate yourself and hopefully get back into work. So these are some of the policies that you could look to pay. Life insurance is the cheapest one. It will need underwriting. The others will need underwriting, but critical illness is probably most expensive. So again, you'd probably have to consider, is that something that you can afford? But then you'd have to ask yourself, is that something that I can't afford? So it's worth looking into any of these types of policies, but it's to protect you and your family should the unexpected happen. And as we know, these days especially, a lot of people are being diagnosed with cancer. I believe it's 1 in 2 that are diagnosed with cancer. So well worth looking at taking a protection policy out. So your 10-step action plan now, just to summarise and to recap. Take a financial health check. Believe this was discussed last week. Look at all your income, your debts, your monthly expenses. Make sure that you're very clear about, everything that goes in and out of your bank account. Set clear written goals. So what are your short, medium and long-term goals? Where do you want to be in the next 3 months, 6 months, 12 months in terms of, financial resilience, having emergency funds? Build a realistic budget, something that's achievable, but maybe a bit stretching as well. Pay off your priority debts first, however you choose to pay those, be it the low interest ones, the smaller balances, but pay off those first. Attack non-priority debts. So start with the highest interest rate first, and try to get rid of those debts as quickly as you can. Stop adding to your debt, so live within your means. And once you've managed to do that, Cut up your cards. If you think, I just can't trust myself, I know what I'm like, then cut those cards up and never use them again. Like I said, build your emergency fund, review your protection requirements, seek advice if you're struggling, and keep learning and reviewing. And that's the best thing about, financial education. There's so much information on the internet now that you can continue to self-educate and learn and watch YouTube videos as well of what other people have done to get themselves out of debt or to build financial resilience. There are free resources, there's Step Change, Debt Charity, Citizens Advice, the Debt Advice Foundation. All these individual organisations are there to help you if you find that you're struggling and you've got yourself into a bit of a rut and don't know how to get out of it. You can call these people and they will give you the advice that you probably need. And key takeaways are savings builds stability. Millions are one shock away from a crisis. Your savings can change that for you personally. Emergency funds protect your future. Even a fund as small as £500 to £1,000 can dramatically reduce your financial vulnerability. Debt limits freedom. We've told in the Bible, the borrower is slave to the lender, and wise stewardship leads to peace. And that's what we all want. We all want to have peace, peace of mind, spiritual peace, mental peace, all of that. And if you can start to implement some of these things today, you will find that tomorrow will look much brighter, much rosier. So these are the key takeaways. Just to reiterate, know your numbers, cut out unnecessary spending, pay your priority debts first and always, avoid minimum payments, protect yourself and your family before disaster strikes, seek professional advice. A lot of the time it's free, and live within your means. Invest the difference, and hopefully your money will work for you. So, those are some of the things that we wanted to share with you today, ending with Proverbs 21, verse 5. The plans of the diligent lead surely to advantage, but everyone who is hasty comes surely to poverty. So, think before you spend, and hopefully you will build that resilience that will keep
Mhm.
you mentally, spiritually, and emotionally happy. Over to you, Pastor, if there's anything else that you'd like to add.
No, thank you so much. I would like to open the platform for questions, but it's been a scintillating presentation. We're so grateful for the insights that we've gained here tonight. Has anyone got any question?
Yeah,
Yes.
good evening.
Good evening.
Yeah, sorry,
Yeah,
sorry,
go ahead.
sorry. Just before we start the question session, I'll put the participant guide on the chat. People can start downloading that.
Excellent.
Yeah.
Okay, thank you. Yes, let's have ladies first.
Um, do you have any recommendations for specific providers, say for critical illness cover?
Yeah, I mean, there's many on the market, and there's people like Aviva, there's Wesleyan, there's Legal and General. Really, you're probably better to speak to a financial advisor just to make sure you get the right level of cover, and they can also seek the best policy for you. Failing that, if you can't access a financial advisor, then you might just want to go online and look at things like moneyexpert.com,
Mm,
or just simply type in, critical illness, income protection providers, and it'll come up with a list of them. And then you can start to sort of have a look at what the costs, the premiums are, and the policies, what they cover, etc. But working with a financial advisor would be your best bet.
okay, thank you.
You're welcome.
And I think the key here, the earlier you start before you have pre-existing conditions,
Correct.
the better, because
Yeah.
once you have an existing condition, life insurance companies will not pay for something that you had already when you took out
Yeah.
their policy.
Mm,
And the older you are, the chances are you will have something that's showing up.
mm,
So sometimes it doesn't seem like it makes sense to be paying life insurance when you're 25. But if you wait until you're 50, there might be a condition
Yeah,
which
and
then
it's
won't be
cheaper.
covered.
Okay.
And the younger you start, the cheaper it is.
Yeah.
Thank you.
I had the gentleman asking the question.
Yeah, I was going to ask, is it, I've had two conflicting advice. Is it best to pay off your mortgage, or is better to pay as much, and when there is just a small amount left, just leave it to just float?
I mean, I'm the kind of person that I take the advice to get out of debt and stay out of debt. So
Mm-hmm.
I threw extra money at my mortgage and I paid that off back in 2014.
Mm-hmm.
So I have that financial resilience that if interest rates go up or if I lose a job, it really doesn't matter. My house is safe and secure. So
Thank you.
only you can answer that. What do you think
Mm-hmm.
is worthwhile? Would you rather use the money that you've got to make investments so your money works for you, or would you rather pay off your mortgage? But I know for me, I don't like debt, so I'd rather
Mm-hmm.
not. But it depends if you have opportunities to invest that you feel are not too risky, that you're not going to lose that money, then you might want to do that. But I always think it's better to pay off your debts, get rid of that. Then, if you do have surplus income, you can start to look to invest that.
Thank you.
Yeah.
Yes, Laverne.
Any other question?
Yeah.
Yeah, go ahead, Sharon.
My daughter told me about a credit card called Wise. I don't know if you heard of that.
No, I'm not that familiar with it. And I know of Wise in terms of they do online money transactions and things. I don't know if it's a credit
Yeah, it's
card linked to them.
online. It's an
Yeah.
online credit
Yeah.
card. She was
Yeah.
suggesting that. Okay, I'll have to look into that then.
Yeah, I'm not that familiar with them, but I do like the challenger banks. I am a Monzo Bank customer and I find them very convenient. I mean, they even do savings pots. You know, you can do the savings challenge starting with 1p, 2p, 3p a day type of thing. And you do that all through the year. And at the end of the year, you would have saved, I can't remember how much it is. It's over £300, but you could do that, daily savings challenge. But yeah, there are many sorts of banks and apps and things that are helping people to save in a very easy, simplistic way.
Yeah.
Yeah.
Thank you.
You're welcome.
Can I
We've
ask?
got,
There's another.
yeah, go ahead.
Yeah, I wanted to find out what advice would you give to young people, which is like 18? They will look at, oh, we don't need to be saving, we don't need to, because that's what like what money you make, they just spend because their parents are there, Well, so what advice would you give to them? Because I was hoping my son would be on here, but he didn't look at it as a priority
Yeah.
to come to listen to this. So what would you suggest?
I would suggest that you encourage your son to save because it's about developing habits that you'll take into later life. And if you develop the habit now of, spending everything that you earn, it's going to be difficult as you get older. And as you earn more money, you'll just end up spending more money. But if you learn to save now, it will become a habit that you will take with you in later life. Once you've gone through university, you've got your first job. So maybe encourage your son to save, I don't know, 10% of his income, 20% of income, but just save something and just get into that habit, make it a discipline in life that he lives by.
Thank you.
Yeah, I think it starts a lot earlier. Children get birthday presents, birthday gifts,
Yeah,
monetary. And we talked about the 50, 30, 20 formula
yeah,
last week. You can start teaching them about that. Whenever they get money, they should learn to put something aside because there's no guarantee that the next birthday, people are going to be as generous as they were this year in giving that child the level of birthday gifts.
yeah.
But with wise planning, that money can then be used to stretch over time. They are building their own resilience, their own emergency fund,
Mm,
because children now even shop online. So they
absolutely.
should not shop online using your credit card. They should
Yeah.
shop online using their own money.
That's correct. But theirs finish as
Yes,
well. If theirs finish, they have to
yes.
ask you.
Yeah, well, you just learn to say no. I know it's hard, but we give my daughter, my youngest daughter, pocket money. There are times we go shopping. She said, "Oh, but I want this." I said, "Oh, well, next month when you get your pocket money, you can buy it then," because they're very smart. They think they can get you to buy it, and then they don't pay you back. But I do make her pay me back, and it might sound mean, but I'm teaching her the value of money. Otherwise, she'll never appreciate the blood, sweat, and tears that go with working and earning an income, and even just being responsible. And you're teaching them responsibility, aren't you? They can't always keep running to mum and dad.
Yes, that's correct.
Yeah,
Thank you.
yeah,
Thank you.
yeah. You're welcome.
Okay, we
More
have
hands. There's two more hands, Patisani and Lisa.
okay. Can we have those two? And Dumiso, what is your question?
Yeah, I just wanted to ask because sometimes there's misunderstanding about life insurance and also critical cover. Just checking the advice. Do you think it's wise to have both of them at the same time? Because I work for the NHS, so I'm just asking.
Yeah,
Because there's always misinformation that if you're working for NHS, you don't need that because you've got indemnity insurance and so forth.
yeah. Well, have a look at the benefits that you've got, because you might have that as an employee benefit, life and critical illness. A lot of employers do provide that, and the NHS, I think they do provide, well, they definitely provide life insurance. The critical illness, I'm not 100% sure. But just be mindful that if you do have that as a perk of your job, when you leave that job, you leave those benefits behind. So there's nothing wrong with having your own policies. And it all depends on how much disposable income you have at the end of the month, if you're able to afford that. So definitely look into it. You can set the amounts that you want. So you might want critical illness and life insurance cover for 50,000, 100,000, and that will determine the premiums that you pay. So have a look at what your benefits are at work, and then, have a look online or speak to an advisor to fund a minimum amount like 50,000, 100,000, but it's worth having protection in place because life does throw curveballs.
Okay, thank you.
Yeah, you're welcome.
Yes, just to add that sometimes we are kept prisoners of certain employers or employers because we know if we leave the organization, we won't have that life cover. So it's always good to have something independent in addition to your employment, like the group cover.
Yeah,
Because again, you could be made redundant any day, and that goes with being made redundant. And then
exactly.
you're going to have to start from scratch to have your own independent cover.
Exactly.
Okay,
Yeah.
thank you.
Yeah. I'll take one more. Our time is up. We want to discipline ourselves on those who started late. We start bang on 8 o'clock and we aim to finish exactly at 9 p.m. So I'll take one more question and then we'll close the session. Was there another question?
Yes, it was me, Pastor. When saving for an emergency fund, which is the best account to put your money in?
I think it doesn't really matter because you're going to put your money in a current account and they don't really pay much in interest rates or anything like that. So whichever is most convenient for you, you're not putting that away to necessarily earn a return for your emergency funds. It's something that you can access easily and quickly should something happen.
Okay.
Yeah.
Thank you.
Yeah, it's called liquid. Your fund has got to be liquid,
Yeah.
easily accessible. Yeah.
Yeah. So it can't be in a term deposit account where you have to lock it away for 3 months in order to earn 3%, let's say. So it's going to typically be in a current account where you can easily access, but they're probably going to pay less than 1/4%, if anything at all.
Yeah.
Yeah.
Thank
Yeah.
you.
But putting it
We'll
under your
talk
mattress
about
doesn't count.
Okay. Once again, Laverne, thank you so much for taking us through this presentation tonight. I believe it's life-changing for someone on the platform, but it
Hopefully.
will only be life-changing if it goes beyond being just information.
Yeah.
This will not serve any of us in any way if we don't act on those points that you shared in terms of the action plan. So I'm trusting that I'll hear beautiful, good stories a year from now